Okay. Good morning. Thank you all for attending, or good afternoon. Thank you all for attending. I'm Andrea Schenker from Schenker and Schenker PLLC. I'm an estate planning attorney. All we do is trust and estates and everything under that umbrella. And with me today is Henry Montag, who is managing partner of the Tolley Center East. He has been in practice since 1976 with offices in Long Island. And he's authored many articles and acted as a resource for the New York State Bar Association, the NYSSCPA, Bloomberg's Daily Tax Report, and Estates, Gifts and Trust Journals, Trust and Estate Magazine, Accounting Today, and the Wall Street Journal, just to rattle off a few. He's appeared as a guest on Wall Street Week, Fox Business News, and News 12, and he has co-authored numerous works, including the American Bar Association flagship publication, The Life Insurance Policy Crisis, The Advisors and Trustees Guide to Managing Risks and Avoiding a Client Crisis. And this was released at the Heckerling Institute on Estate Planning in 2017. I've worked with Henry for several years on many different matters, and he is a very trusted resource and valuable resource in the life insurance arena for me and for estate planning. And with that, I will hand the beginning of this presentation off to Henry.
Thank you very much, Andrea. I'd also like to thank Cindy Doler for putting this program together. And Andrea, thank you very much for what you've done and what you're about to do. So my objective as managing partner of the Tolley Center East is basically to provide guidance to amateur trustees, which are basically your clients, sometimes eldest sons or daughters, and try to get them to maximize the value of their insurance portfolio. My objective today is to try to provide you with some information that might prevent some of the problems that I'll be discussing in terms of funding ILITs or business agreements or various other special needs trusts. So with that, let's go to the agenda. Starting with the course agenda, things we'll be talking about. We'll be talking about the attributes of trust-owned life insurance. We'll be talking about funding of the ILITs and other trust agreements, special needs trusts. We'll talk about the 6 most popular types of life insurance policies and the best uses for each. We'll talk about problems with consumers. Okay. And much of the information that I will be talking about comes from the book that Andrea mentioned a little while ago, the Advisor's Guide to Managing Risk. Next slide, please. And you could skip over the next one as well. Thank you. Okay, so types of trusts and agreement. We'll be talking about the irrevocable life insurance trusts, otherwise known as ILITs. We'll be talking about revocable trusts, which do a good job of providing management. I'll talk about the special needs trusts as well as buy-sell agreements. And lastly, talk about the deferred compensation agreements, which are usually funded with life insurance. Next slide, please. So the attributes of trust-owned life insurance. I think that if we look at the risk transfer mechanism, it's a very sophisticated financial tool, and it provides creditor protection, it provides management, and it's ideally suited for trust ownership. But life insurance policies are not self-managing, and an inadequately funded policy can and does lapse. When I came into this business, it was simple. Back then, it was like a Carvel. It was whole life, and it was term insurance. It was chocolate and vanilla. Once we get into today's day and age, it's more like a Baskin Robbins. Next slide, please. It's more like a Baskin Robbins with 18 different flavors. We can provide insurance for death benefits, for accumulation, for living benefits. There are guaranteed products, non-guaranteed products. There are variable products, index products. There's no such thing as a bad policy, only a misused and mismanaged policy. Forward. So, rather than my talking about the purpose of an ILIT when I have an attorney sitting next to me, Andrea, can you pick up on talking about the purposes of an ILIT? Andrea, you're muted. Andrea, you're muted.
Sorry about that.
Yes.
An ILIT, otherwise known as an irrevocable life insurance trust, is for the purpose of being the owner and the beneficiary of only life insurance. Its purpose primarily is to get the death benefit out of the taxable estate for estate tax purposes. For instance, if I have an estate worth $4 million, but I have $3 million in life insurance, the life insurance, believe it or not, is part of my taxable estate. So I have a taxable estate of $7 million. And in the state of New York, where the state estate tax exemption is currently $6,580,000, not to be exact or anything, that means I'm over the threshold and an estate tax will be owed. What's more interesting is that New York State, if you're even 5% in excess of the threshold, that's 6.58 million, then there is no estate tax exemption, and there is a calculation to tax the estate from $1 at a highest rate of 16%, and that tax is due 9 months from date of death. That is separate from the federal estate tax exemption, which is currently $12,920,000 and a top tax rate of 40%. But if the life insurance policy, that $3 million, is owned by an ILIT at the time of death, and you've survived 3 years from transferring it to that ILIT, if it was an existing policy, and if it's a new policy is purchased by the ILIT, it's day one, the 3 years, then a death benefit is completely excluded from the taxable estate. That's one purpose of the ILIT. Another purpose and another advantage is that it creates a management structure for that death benefit, for the benefit of surviving spouse, for minor children, for children with special needs. You know, a trust is, a trust is a set of directives, and we have so many different types of trusts for various different purposes. This ILIT, the Irrevocable Life Insurance Trust, is really for the purpose of management of life insurance, and it works beautifully. It is asset protected, meaning it protects the assets within the trust. Now, life insurance, many of you may know, you may not know, is an inherently protected asset. But if you name an estate or it goes into the general estate upon death, it is no longer protected. If you put it into an irrevocable life insurance trust, it maintains that asset protection as well. Some people will have very large amounts of life insurance, term policies. Some people have large amounts of universal or whole life policies. But the structure of an ILIT works very well for estate taxation mitigation and for the asset protection. While the insured is alive, that trust will, as I said, be the owner and the beneficiary. The insured will not have any control, meaning the insured cannot be the trustee. Oftentimes, the insured names a spouse or another relative if they're unmarried, or a life partner. And the reason being is the IRS equals control with ownership. So if you give up your control, it's not, you don't really own it. If you don't, you're not taxed on what you don't own at time of death, if that makes sense. Upon death, then typically we see that the surviving spouse will be the primary beneficiary, because that's when the death benefit's going to pay out. Now, it's a surviving spouse or whomever the primary beneficiary is cannot act as a trustee exclusively. Again, we want to keep it out of both the surviving spouse's estate and the decedent's estate. So we have to name a co-trustee for an element of giving up that control. So if it's me and my husband, Mike, for us, and we have them too, not because we are vulnerable to an estate tax, but we have very young children, and we have a lot of life insurance because we have very young children. We name each other as a co-trustee with another individual. Some people name other individuals, some people will name corporate trustees, and that's a whole other presentation. But for the remainder of my life, if Mike predeceases me and his trust is funded with a death benefit, then I'm entitled to the income and as much principal as I need for health, education, maintenance, or support. And if I need to, the income will be a stream. It's preferable that it's paid out to me because it will be taxed to me individually instead of being taxed at a trust level if it stays and accumulates within the trust. But that's a decision that the co-trustees make together. And then whatever is left in there at the time of my death is going to be for the benefit of my children, but it will be completely excluded from my taxable estate, despite how much it appreciates in value because I've invested it so well and made brilliant financial decisions. It could be worth $40 million and it's still estate tax-free. It has remained asset protected. So the irrevocable life insurance trust is an invaluable tool. And I have directions about how my beneficiaries, at the time of my death, and I have a mirror document as my husband's, how the trust principal will pass to my kids. They will also have a continuing trust where they have access to as much income and principal as they need for health, education, maintenance, and support. And remember that this is separate from my general estate. It can be used for paying for higher education. It can be used for medical emergencies. It can be used as a down payment on a home or to begin a business or investment, but they will be subject to trustee discretion. And my kids are minors, so obviously they can't, even if I wanted to give it to them outright, I couldn't. But as they get older, I consider, payout terms. And I usually will use ages, age 25, age 30, age 35, and that differs, according to the family structure and what the goals of the family are. But again, this all passes ultimately estate tax-free.
So why don't you give us an example of what it would look like working with, say, the crummy letters and the crummy provisions?
That's on
Next slide.
Okay. So crummy is not a description. Crummy was a person. Crummy was a very infamous case back, I think it goes back to the 1930s, where, or I could be wrong about that, so don't hold me to it, but I do know the story. He had a lot of life insurance. The premiums, it was very expensive, and he wanted to get away with protecting the money, removing it from the taxable estate, and not having it be considered necessarily a gift, a taxable gift. So what he did was he created a trust with a bunch of beneficiaries and different tiers of beneficiaries. So he gave it to, A, B, C, D, and E, and then if all of them predeceased, then it goes to, the rest of the alphabet in tiers, and so on and so forth. And then he would say that each of them, because they don't exceed whatever the annual gift tax exclusion was in the cost of the premium, today that's $17,000 per person times 26, however, are in that alphabet, then he doesn't owe a tax, and it maintains the structure and the death benefits outside of the taxable estate. But the IRS, the government, said no, because this is not considered a present value gift. We can use annual gifts, the annual gift tax exemption, and give as many people. I can give all the attendees right now $17,000 if I had it to give. And I wouldn't incur a gift tax because I'm presently giving you value. I'm giving you that $17,000, and the IRS does not care about that number. They don't want to keep paperwork. But if you start to go beyond that number and say I'm giving $100,000, that's chipping away at my lifetime gift tax exemption, which is over $12 million. That's, again, for another seminar. With Crummy, the case went all the way to the Supreme Court, and he won because he had issued a letter to each of the beneficiaries saying they had a limited right to withdraw the value of what was considered a gift for their future benefit, but they have now to claim it, making it a gift of a present value. So a present value gift. So he won, and now we get away with this because we write crummy letters. Dear so-and-so, you please understand that a gift has been made in so many words on your behalf with the value of whatever that premium is, and you have the right to withdraw within a certain amount of time. And it's signed, and that's it. It's tucked away and saved in records. That way it can maintain that present value gift, and we're not using any part of the lifetime exemption. And the one other thing that Henry very smartly has in here is just to remember, I kind of sped right through it before, the 3-year transfer rule and contemplation of death. That means that if I have a life insurance policy and I meet with my trusted estate plan attorney who wisely says, please put this in an irrevocable trust, creates the trust, we create the trust, and then I assign ownership and beneficiary. I better survive 3 years because the IRS thinks I'm planning my death and I'm going to cheat them out of their money. So that's the 3-year death in contemplation rule. If I survive those 3 years from transferring an existing policy, then the death benefit is removed from my taxable estate. Alternatively, if I buy life insurance through Henry today, from day one, it's purchased by the trust. It's from day one, it is excluded from the death benefit from the taxable estate altogether because I was not contemplating my death, even though I was buying life insurance.
Yep. Try to explain that one. Thank you. That's a great explanation of both. Forward the slide, please.
Okay.
Okay, so a couple of things to consider about the world of life insurance. Term insurance is the most popular coverage, and I'll get to that in a moment, you've got to be able to match objectives with the correct product. There are an awful lot of misconceptions about pricing. I can't buy that, it's too expensive, or someone's concerned about the fact that they had a heart attack or a case of cancer years ago. There are a lot of misconceptions about assumed returns, which we'll talk about in a moment. Many people should be concerned, will my life insurance expire before I do? Simply because there are so many different opportunities for a life insurance policy to expire prematurely simply because of bad assumptions and mismanagement. There's an alternate exit strategy called the life settlement. What's the best policy for me? How do I put together the right products, the right features, the right benefits, the right terms? Which additional riders should I consider? Have someone who's a trusted independent advocate advise on your behalf. And whether it's a trust owned policy or a personally owned policy, the mechanics are the same. And again, all life insurance requires active management to have it be fully functional. Next slide, please. So how many times do people actually buy this during the course of their lifetime? Well, perhaps when they buy a house, perhaps when they have a child, starting a business, applying for loan. Certainly if there's a business involved, there should be a buy-sell agreement, which would be a big plus, and a plus would be to actually have that buy-sell agreement funded with life insurance. Having an agreement is wonderful, but unless you've got the money to be able to complete that transaction, that buy-sell agreement may not be worth the paper that it's written on. If they use a deferred compensation plan to be able to supplement their retirement, they'll certainly be using a life insurance policy for its tax-deferred accumulation. When they want to create a legacy for the next generation, they'll certainly be using life insurance. If they want to pay for long-term care costs from the death benefit of life insurance policy, and certainly when they prepay their federal, state, and inheritance taxes, the least expensive method of paying for that is, of course, with a life insurance policy that is already income tax free, and as Andrea mentioned, if set up properly, can also be federally state inheritance tax free as well. Next slide, please. So let's very quickly go over the 6 types of life insurance policies. Most common is term insurance. Certainly the most common type of life insurance, but one's got to know what's the purpose of the coverage and how long does the client want to keep the coverage in force. Yeah, I have life insurance, but it might be year 17 in a 20-year policy with only 3 years left. But what the insured remembers is that, yes, I have $1 million, $2 million life insurance policy, but doesn't really recall when it might end. And by the way, all term life insurance expires anywhere between age 80 and 82. So what's guaranteed in a term life insurance policy? The death benefit is guaranteed, the premium is guaranteed, and the duration is guaranteed, whether it be for 1, 5, 10, 15, 20, 30, or even 40-year period. Those 3 options are guaranteed. There's also the opportunity to purchase group association term. If anyone has group association term and they're over age 40, please consider sending me an email and ask for the group association term article. It's a wonderful product up until age 40, 45. Beyond that, it's one of the worst products that I've ever seen. So as I say, only because term insurance expires between age 80 and 82, only 2% of death benefits ever get paid. And what are some of the incorrect uses for term insurance? Well, if you're setting up a special needs trust and you want to make certain that your child has access to that money, you certainly don't want to have a policy that expires perhaps at age 80 or 82, having a parent live beyond age 82. There wouldn't be any funds available for that child. Or if someone's looking to leave a legacy and they're hoping to live beyond age 82, term insurance is not a good idea, although I've seen many ILITs funded with term insurance. Next slide, please. Most popular type of life insurance is something called a whole life policy. This goes back to the old days of chocolate and vanilla. Whole life insurance is guaranteed. It's a way to accumulate maximum cash value in a policy. It's all guaranteed. It will last for the rest of your life. Client assumes zero market risk. Everything is there. Everything is available. And all the client has to do is pay the premiums and pay them on time. What is cash value life insurance, or what is cash value? As an example, let's just say that there's a $10,000 premium. And in the first year, there are various expenses, including the underwriting to write that policy, administrative costs, paying the salesperson his or her commissions. So we subtract the expenses from the 10,000 and we have, as an example, 4,000 left in cash value. Guaranteed returns of 3% on that 4,000 equals approximately $120. So at the end of the first year, the net cash value is 4,120, and then that process repeats again in the second, subsequent, and ongoing years. It's a good vehicle for conservative return and for accumulation. Next slide, please. Something called indexed universal. It can be guaranteed, but instead of earning 3%, the return is provided based on an indexed return. And to boot, an individual can protect himself, herself from any losses by accepting only 75% of any gains. The other 25% goes back to the insurance company. But for that 25% that they give up, there's a floor on losses. There is a zero floor. So if the index goes down 5, 10, or 15%, the individual insured does not lose any assets, any cash value, because there are no losses in an indexed universal product. Next slide, please. Unlike the index, where there are no opportunities for losses, a variable life insurance policy works on the basis of individual mutual funds, and the client assumes 100% of the market risk. So if the individual, well, let's just go on to the next slide and I'll come back to that in a moment. What are the problems with a variable policy? Well, let's go back to 2020. Client purchases a variable life insurance policy, yet in 2022, that index declines by 29%. What needs to be done is a significantly higher premium should have been paid to make up for the loss in 2023, for the loss in 2022, a higher premium should have been paid in 2023, but this is typically not done. The shortfall compounds and eventually becomes unmanageable. Trustee eventually receives notice that the coverage will expire in 12 months unless a significantly higher premium is paid. And unfortunately, some people say, insurance company, I'm not paying that higher premium, or I can't afford to pay the higher premium. Either way, it results in the duration of the coverage expiring prematurely. Next slide, please. Most popular type of non-guaranteed policy is something called a non-guaranteed universal life insurance. Why? Because it's less expensive than the whole life policy, which is accumulating assets. The non-guaranteed universal goes on the current interest rate. Now, here's the problem. Many years ago in the early 80s, when interest rates were upwards of 21%, E.F. Hutton decided that they were going to, in addition to their investment world, that they were going to create a life insurance policy with current rates. And they decided to call that, they didn't use the word non-guaranteed, but they called it universal life insurance. They should have said non-guaranteed universal life insurance, because heretofore, term insurance was guaranteed to last for the guaranteed duration, and whole life insurance was guaranteed to last for the rest of one's life. So people naturally assumed that any type of additional life insurance would also be guaranteed and would last. And that was really where the insurance company dropped the ball. Many people assumed interest rates were 20%. So let me assume I'll be conservative and I'll assume that my policy will earn 12%. When interest rates began going down below 12%, below 10%, 9, 8, 7, individual owners, trustees should have increased the premium to be able to make up for that loss of income between the 12% that they'd originally assumed and the 5, 6, 7% that was actually being paid. So as interest rates decreased, the coverage duration decreased. But the insureds weren't aware of that they should have paid a higher premium. And as a result, while it was less expensive, it was not guaranteed. And the insurance industry did not do a good job of communicating that, which is one of the reasons why the American Bar Association asked us to co-author a book on the subject. And while I wanted to call it The Advisor's Guide to Managing Risk, the American Bar Association decided to call it The Life Insurance Policy Crisis. So you can imagine how bad it must be. Next slide, please. The answer to, or why is non-guaranteed universal life insurance a problem? Basically because people consider life insurance as a buy and hold asset rather than a buy and manage. Because with the term insurance or the whole life insurance, all they had to do was put the policy in the bottom left-hand drawer, pay the bills as they came up, and the beneficiaries will receive the death benefit. Unfortunately, they didn't know that they should have. And as a result of the years, policies are expiring prematurely, and they increasingly, consistently are expiring prematurely each and every day. Next slide, please. What does the Wall Street Journal have to say about this? Well, enough so for the senior editor of the Wall Street Journal, insurance and finance editor, to write this forward into our book as an endorsement. And I'll just be quiet for a moment and just let you read this for a second. There are a whole host of reasons why policies expire. The editor of the journal just picked on a few. People are not paying attention. People have underfunded, and people are no longer in touch with the sales agents that should have been helped manage that policy. When I say should have, it's good business sense to do that. It's not an obligation of, unfortunately, of a agent or broker. It's just something that would have been a smart thing to do. Next slide, please. What does the insurance industry say about this? Well, the IMSA, general counsel for the IMSA, said that yes, life insurance policy is a problem and policies are actually expiring. That was a big thing for the general counsel for the IMSA to say that. And why might this be a problem? Well, here's page 5 of a 7-page annual statement of an annual report. And the important notice is my lettering at the bottom. But if you look at the bottom where it says important notice, it actually says changes in interest rates may impact. No, they will impact. Point is, if this were really an important notice, in my opinion, it should have been plastered at the top of page 1 in large, bold block letters to bring attention. But you know what? Life insurance companies like when policies expire because they get to keep all the premium and never have to pay out a death benefit. Next slide, please. So after enough complaints came in, the life insurance industry in 2003, 2004 began coming out with a guaranteed universal life policy. It was a very smart idea, and many individuals are today using the guaranteed universal, although it is more expensive than the non-guaranteed universal, but you do get what you pay for. And as long as an individual pays their premiums on time, the death benefit is guaranteed, the premium is guaranteed, and the duration You can actually say, I want my policy to last until age 95 and the premium will be X. If you want it to last to age 96, it will be a little bit more. If you want it to last to 94, it will be a little bit less. Point is, it's a guaranteed product, and the only type of a universal product that, in my opinion, individuals should consider is a guaranteed universal. It is not for accumulation. It is only to provide a death benefit and to provide a maximum death benefit for the least expensive premium. Next slide, please. Andrea, perhaps you could just talk for a moment on the idea of a buy-sell agreement. Andrea, you're still muted. Andrea, you're muted. Andrea, okay.
So sorry. Okay. Buy-sell agreements are, it's a classification of an agreement. We typically use them to set forth terms for the potential sale of a business or of business interests. For smaller businesses, of course, this can be done with LLCs, with corporations, what have you. There's many different styles of doing them. I've done many of them. I've done them for law firms, for accountants. I'm doing another one for an accountant and an estate right now. I've done them for other sorts of businesses as well. Some family-owned businesses where some of the partners are family and some of them are not. And so you have maybe a father and a son, and then a third party who was together with the father for many, many years, but whose family has no interest in coming in. And what it does is it sets forth the terms of exit. So what is exit? Well, the obvious one is death. The other could be retirement. Voluntary exiting is retirement. Involuntary, somebody is irreparably injured or disabled, or or there's some kind of cause for being fired or being told to leave. And all of these terms are negotiated, but there has to be a way to pay for them. In the document itself, the document will define a formula to come up with a value on of the actual business. Some people will value it and have it appraised on an annual basis. Some people will just do it at certain points in time. Some businesses will do it as of the birth of or the signing of the commencement of this agreement. And then there are terms as to how you design your valuation as well. It provides for disability. It can provide a buyout by the remaining partners in there or owners. If there's a permanent disability and there's no disability insurance, what defines permanent disability? If there is disability insurance, there's always going to be a trigger as to when that can be paid out, and it has to be negotiated because disability insurance is usually very expensive. For death, that's a more complicated question, because now if you have a business and say, I will take my business, I'm a lawyer and I have 2 partners right now. So say one of those partners happens to be my father. Well, he is. And then another partner is not my father. I'm the obvious business succession plan for my father, but my other partner, his family, none of them are attorneys, and most likely he would not, his family has no interest in going to law school, let alone practicing law, and they don't have licenses currently. So what happens upon the death of an exiting owner? And is there money to pay out to the estate in return for that interest? And that's something that you have to determine. Life insurance is a perfect tool for this. It's usually cross-purchased with the owners. You buy mine, I buy yours, and there's wonderful strategies for this, and it works beautifully. We base the value of the life insurance on an appraised value, expected value of what the ownership share would be. If there's not enough money in the death benefit at the time of the death and we're trying to settle out the estate, well, there's a formula for that too, about how it can be paid over time and how that is done to the estate. If there's a surplus, well, the surplus goes, back into the business. But these are all defined terms and it's a negotiated document, and it does work quite beautifully. Do you want to add anything to that, Henry?
Sometimes a business might be worth several $1 million and it could result in a conflict of value between the IRS and the individual. But having a funded buy-sell agreement does help, in my opinion, peg the value of the business. Have you found that in your practice?
Yes, absolutely.
Yeah, that's the only thing I would add to that. And an individual can have two different types of insurance policies for a buy-sell agreement. They can have a term policy, which provides no accumulation value, but provides the maximum death benefit for a perhaps 5, 10, 20-year period, or however long the business might stay in force. Or they could have a permanent product, which provides for a tax-deferred accumulation of cash value. And that excess cash value can be used later on to help fund an individual's retirement. So there are different purposes and different products that are available for a buy-sell agreement. It just depends on the individual's objective. And I think if you want to pick up on the next slide as well.
Okay, so the trust, so with how long does this contract remain in force? And it does all depend. Advisors' roles. In here, you know, the CPA, the attorney, and the trustee, or let's just take the CPA and the attorney to start with, we're involved in the crafting of and design of this structure. So there are certain buy-sell agreements that are known to be classified as a trustee document. And that means that there's an individual who is selected to kind of be a babysitter for the entire thing. They're the ones that are in charge of keeping records. They're in charge of picking the appraisers, approving the valuations, the value of everything. Sometimes that is the wise idea if there's a lot of conflicting interests. You never really know with this until you sit down at the table. I have had 2 in the past year that have basically gone into paralysis and then been revived and then back into paralysis because they would get to points where they really could not at all agree. And they were so drastically distant from a mutual agreement of terms in the agreement itself. They were already working on the life insurance, but so much can go into this, and it brings out the human side of the whole picture, which is the emotions and the dynamic and the relationship between the people. So in that sense, you know, a trustee and having more advisors around can be extremely helpful to keep things moving along as an impartial participant, if I may. But they do work very much the same. We're all here to kind of bring everybody together and keep things moving forward smoothly.
Yeah, there's certainly a lot of things that you as an attorney have to discuss with the client. If you forward the next slide, you know, there's certain things that you do talk about, and there's certain things that the CPA talks about, and there are certain things that you and the CPA don't talk about. And fortunately or unfortunately, the life insurance is oftentimes one of those things that not enough attention is paid to. And if we just forward the next slide. We could both talk on the idea of the private trustee's role in monitoring totally, because my experience is that the insured knows very, very little about managing a life insurance policy, and his or her eldest child knows even less. What's your experience been with what I call the amateur trustee, or the, just basically a trustee who's just acting as an accommodation because his or her parent asked him or her to play that role, but basically never gave them any rules or any information or any guidance or any advice. And unfortunately, my experience has been is that an awful lot of times the eldest son or daughter assumes that everything's taken care of by his or her parent, and that attorney for the insured is also going to be acting as the attorney for the trustee. And, maybe you could just pick up on the liabilities of the trustee, or the responsibilities and the
Well,
responsibilities.
that's a very good point. I mean, and it also, trustees have liability. And, Henry was speaking earlier about the failing policies. They're responsible for it because the trustee is the trust's fiduciary. They're obligated to act in the best interest of the trust beneficiaries. And if they're not noticing that the policy itself is dying and going to economic waste, they can be held responsible for it. In my case, in my practice, because this is all we do, when we have clients with irrevocable life insurance trusts, whoever they name as trustee, we emphasize that. We also encourage our clients to have family meetings with us, with the members of their family or their friends or whomever they are naming as trustee, to come in and talk about what their responsibilities are and what they should know. Usually, in my case, the clients themselves, who are the insured, are really monitoring or trying to monitor their own policy. But I've had clients come into me. Once I had a client come in and to look at policies he had purchased and had put into irrevocable life insurance trust with a friend from church who happened to be an attorney who said he could do that for him. And this gentleman had over $20 million of life insurance, and they were in the wrong trust. There was a second to die policy, meaning it's the insured is the husband and the wife. It pays out on the second death. It was in his individual life insurance trust. It should have been in a second to die trust. Then there was an individual policy for him that made him a preferred non-smoker. The guy smoked 2 packs of cigarettes a day, and he had just purchased this. So there were a lot of problems with that. We did get him fixed up, and everything was corrected, thank God. But that was a long time ago. But I've seen things like that since. Clients using copies of their documents, of their trusts. I had one where Henry and I think we worked on that together with that woman who couldn't find the trust.
Yes.
And there it can be across the board. You have to make sure that your clients, if you're setting this up, you know what you're doing, or you're working with someone who knows what they are doing. And that always keep the documents together, keep records of everything, because we can't just reinvent the wheel based on thin air. If there's no trust document to be found, not even a copy of one, then there's no trust, and this it could be a litigated issue, and it would require court intervention, especially if the carrier of the life insurance, they have it on record that it's trust owned, but nobody can find the trust, and the life insurance companies, they don't keep copies of their clients' trusts. They use what they need to put it on record as the owner and beneficiary designation, but they don't keep a file with a copy of the trust.
Right. They usually keep the front page with the
signature pages.
Signature page, and unfortunately, it's not enough. And I just want to add one thing to what you just mentioned. 90% of the trustees are what I consider to be accommodation trustees or amateur trustees, or just the eldest child acting as trustee, and only 10% are actually institutional trustees. And why is that imbalance so significant? Well, because institutional trustees charge a fee for acting as a trustee, whereas the son or the daughter will just go ahead and do it because mom and dad is asking them to. Well, you do get what you pay for. I think if we follow the next slide, we'll be able to look at the agent's role. And again, there's no responsibility on the agent's part to go back and service the client, believe it or not. And why doesn't the agent do that on his own? Well, he or she may be embarrassed to go back and say, hey, that $5,000 policy, that $5,000 premium, you should now be paying $6,000 or $7,000. And there's no financial gain for the client, for the insured, to have his or her agent say something, because the lion's share of the commissions are earned up front by a salesperson. And there's no obligation to come back, and there's no financial incentive to come back. Not to mention that a good percentage of individuals in the insurance business wind up leaving And lastly, it's a perfect storm. Clients don't really understand the policy emotionally. They don't want to talk about it. And unfortunately, they don't trust the information coming from the individual that's getting the information. Next slide, please. So again, whose fault is it? Well, insurance company should have contacted me. My agent broker should have contacted my attorney, my CPA, but no one told me that my policy needed management. It's none of their legal responsibilities. It's 100% the owner's trustee's responsibility. Next slide. Andrea, could you just talk a little bit about your experience with institutional trustees' role in trust-owned life insurance for a moment?
I deal with a lot of institutional trustees, both for life insurance trusts and for general trusts. Institutional trustees are organized. They're set to a very high standard. They will do all of the paperwork, the tax work. They have compliance departments. They don't die. They don't take sick days. They function very well, especially if, and there's a lot of people out there can't name a trustee or a fiduciary, or they can, but maybe that person doesn't have quite the best skill set. So you pair an institutional trustee with an individual and make them co-trustees. Then you have the human touch of somebody who is, it has some kind of relationship with the beneficiaries, or maybe a beneficiary themselves. And then you have the institutional trustee who's always going to be there and do things in a very organized, regimented, and regulated way.
Okay, thank you. Next slide. So, benefit of a life insurance audit. There are a lot of benefits, but the bottom line, it's, as far as I'm concerned, it's to be able to compare what you think you have to what you actually have, and compare that to what you actually want. Okay, next slide, please. Reacquainting with your life insurance portfolio. Again, most important point here is to know how long your policy will last. Everyone knows the death benefit. Everyone knows how much premium they're paying. Everyone knows what company. But when I ask them, how long will the policy last? Oh, it'll last for the rest of my life. Well, how do you know? Most important thing, as far as I'm concerned, is to review your portfolio, is to make sure that it's updated and to make sure that the trust documents holding are also updated. Beneficiaries do change. Again, as Andy mentioned just a moment ago, have you named the contingent owner or contingent beneficiaries? Very important. Next slide, please. To avoid a problem, the client has to obtain what I consider to be the most important document, a historic projection, something that actually talks about how much premium has been paid and what the results of that premium payment are based on the returns over all of the years that the contract has been in force. When you have a problem, what are some of the ways to fix it? You can either reduce the face amount, you can either pay a higher premium. If you're healthy, you can still obtain a new guaranteed contract if you're qualified, or you can go ahead and sell the policy to an institutional investor or some combination of the above. Next slide, please. Trustee's responsibility is to make sure the coverage doesn't expire. Very simply, it just comes down to a buy and hold philosophy as opposed to a buy and manage. And an awful lot can be accomplished by obtaining that updated illustration of that historic projection that I just mentioned, and being aware of the changes in interest rate, and being aware that the stock market returns for a variable policy do significantly change. Everything is important, but it revolves around obtaining that historic projection and then analyzing it, basically like a stress test. Next slide, please. The adequate funding statement is, as far as I'm concerned, one of the most important things, because people might be able to pay for the premium today, but what if the situations change? What if the stock market has a couple of these bad days or bad weeks or months? Just basically to be able to demonstrate that the trustee is thinking ahead, it's important to be able to make certain that the premium payments can be paid not just today, but in the future as well. Next slide, please. How's this matter handled in your office? You've got a client with a $2 million policy. He's age 82. His premium is currently $29,000, but he just got a letter from the insurance company that it's now insufficient. New premium should be $38,000, and that's only required. That's the amount required to only keep the policy in force until age 90. He's already paid $580,000. What do you do? These situations will come up, and if you don't have the information available to help that client, hopefully you do have a resource you'll be able to refer that client to be able to obtain that historic projection and provide that stress test to see what can be done. $580,000 could be lost if the policy lapses before the client. Next slide, please. Mentioned a life settlement. Life settlement is nothing more than an alternate exit strategy. You can sell your house, car, boat, and you can also sell your life insurance policy, but most people aren't aware of that. You can sell your life insurance policy and turn a bill into an asset, or in the case below, 84-year-old client had a $5 million policy. Premium is $82,000. Cash value is $1.6 million. Client decided that he didn't want to continue to pay that $82,000, and instead of providing a future death benefit, client decided that he wanted to give that $1.6 million death benefit to his children. So he decided to surrender the policy for the cash value. Fortunately, his attorney suggested, why don't we explore a life settlement? Bottom line, we obtained an offer for $2.2 million, basically $600,000 more than the cash value. By simply selling the policy, client gained an additional $600,000. Plus, we retained $250,000 as a retained interest for the family. Next slide, please. The state taxes, as Andrew mentioned, the state taxes today close to $7 million. For individual, will be reduced to the $7 million. Currently, we know that it's a $13 million personal exemption. So not many people pay state taxes, but when it gets reduced to $7 million, many additional individuals will be looking at estate taxes. So we need to be able to find a better way to pay for those future state taxes, and insurance is certainly one way to do it. Next slide, please. You can use, as I mentioned before, a permanent life insurance policy with cash value to supplement an individual's retirement, whether that's a executive retirement plan, supplemental executive retirement plan, or supplemental owner's retirement plan. It works the same way. You take advantage of the tax deferred accumulation, and if it's set up correctly, you can, through the sophisticated use of loans and surrenders, provide not only tax deferred accumulation, but also tax-free distributions. And that, again, is a different topic and a different subject to be spoken about another day. Next slide, please. Let me just go to the next slide because we're running out of time and I want to finish. Talking about estate taxes, there are two ways to pay for estate taxes. One, your own pocket out of your own money. Two is a traditional life insurance policy, or three is something called a second to die or a survivor joint life policy. It's less expensive for a second to die policy in many cases than it is to use an individually owned policy owned by one person, especially since estate taxes are due at the second death. Next slide, please. And we just finished on time, and I'd like to leave the next couple of moments for any questions from the audience. Andrew, just wondering if there's anything that I mentioned that you might want to add to while Cindy or Nicolette are looking for any questions that might have appeared?
No, I think you did a fine job. A lot of valuable information in there.
Yeah, again, apologize for the delay in the beginning, but we did get through that after 4 minutes, so I apologize for that. Cynthia, just wondering if there are any questions in the queue, or
yes, Henry, we have one question. Can you convert a term policy to a second to die?
You can convert a term policy to a permanent policy, but you can only convert a term policy that insures one person to another policy that only insures that person. So the answer is yes, you can convert a term policy, but no, you can't convert a term policy on one individual to a second to die policy on two individuals.
Okay, thank you so much, Andrea and Henry. That was a wonderful presentation. The CLE code for today is 905L as in Larry, 905L as in Larry. All righty. I don't
And I
see
just
any
like
other
to,
questions. Pardon me?
and I just like to add just one point. There
Sure.
are some handouts in there that contain an article from Bloomberg that was just published specifically on the idea of what can be done to be able to maintain life insurance in various trusts or other agreements. So, certainly please hit the tab and obtain that. And I know that Andrea and I are available resources for any questions that a member of the audience might have. With that, Andrea, any closing comments?
No, that's it. I just want to thank everybody for your attention, and it was a pleasure.
And thank you again, Cynthia and Nicolette and Andrea, for joining us and putting this together.
Okay.
All right. Have a great day, everybody.
Have a great
Thank
day.
you very
Thank
much.
you.
Thank you.